Hi, and welcome to the Stockscores Market Minutes for September 7th, 2015. This week I want to talk about the process map. Trading effectively requires applying a winning strategy with a mechanical process. Simply having a good strategy, good rules, doesn't mean you're going to put those rules into practice effectively. It's the process, the step-by-step process that you take to get to identifying your trades and executing those trades that is so important. You want to map out the steps you take to identify and evaluate trading opportunities. And in doing so, make sure that you include every little step where the processes repeat, where decisions are made, and also consider time as a factor. What do you do at a certain time of day, or what do you do on a certain point in the week? Include multiple strategies for different market conditions and scenarios. I'll trade the market differently if we are in a corrective phase than I will if we're in a bull market trend. And so those different concepts should all be built into your process map. All right, let's get into this week's analysis. Here's a chart of the S&P 500 intraday, 30-day, going back 30 days for 60 minutes at a time. And you can see that we had the sharp correction there in August. A lot of volatility, compared to middle of August. There's been a lot more volatility lately. That shows the uncertainty of the market. And we sold off, we bounced, and we're now building a little pennant pattern here. And it's now a question of whether we will break up or down out of that pennant. And so I think early next week we'll probably move up because we'll test that upper boundary of the pennant again. But if we break down through the green line, then we could go back to retesting the lows of late August. So we want to keep a close eye on this chart. Again, just look at a 30-day chart. I like to use a 60-minute. You can use a 30-minute interval. Keep an eye on that. Big picture, we've broken that long-term upward trend. And so typically what happens is you'll get people second-guessing the breakdown. And that's why I think we could see a break up out of that pennant. A break up out of that pennant doesn't mean we're going to move to new highs. It could simply mean that we move up into the 205, 207 area on the SPY, and then find resistance, roll over, and make a more substantial correction into a bear market out of that pattern. What we want to watch for is the market able to rally to new highs, or will it make a falling top? We could make a falling top as soon as next week if we broke down out of that pennant. But I think more likely we'll break up, but that doesn't mean that we're out of the woods yet. We could, simply go up for a couple of weeks and then maybe in October roll over and make a more dramatic sell-off. So the short answer here is we want to be cautious with stocks longer term. Short term, lots of volatility. That makes trading entertaining. All right, here's the Russell 2000. It doesn't look as bad as the S&P 500 because its upward trend line hasn't been broken. I could draw a line across these bottoms here, and you could see that wasn't really broken yet. We do have a downward trend that's been underway for about 2.5 months, and a little oversold, so it probably rallies up a little higher, but until it breaks that little downward trend line there, don't get too excited about things. Here's the TSX on an intraday basis. Again, the 30-day, 60-minute chart. You can see that basically tops are falling on that chart. That means the sellers are in control. We do have some short-term support building here, but with the pessimism in that pattern, that's not really a good-looking pattern. What we need to see if you're bullish on stocks, or if you want to be a buyer of the Canadian market, is you need to see this red line get broken. So watch for that red line, which I've drawn across the tops, to get broken on the intraday chart. If we break down through the green line, which could happen next week, then we're going to probably move down to retest the lows down around in here. So I would say it's still a negative looking chart, but certainly that could change very quickly if we break that downward trend line. Big picture on the TSX, you go back for the year, we've really done nothing, going back even to 2014. So all of the gains of 2014 have been taken away, and lots of volatility lately. That shows the uncertainty of the market. But, in the last year, we're kind of in the sideways range at the lower area of that range. So we could find some support there. I just think you got to be pretty cautious here still and be real specific with stocks that you trade, trading only the stocks that have real good patterns. Because most stocks in the Canadian market don't look all that great. Here's the TSX Venture, and this is actually interesting. We finally built a little rising bottom and broken a downward trend on the TSX Venture. That's the first time in a long time that's happened. And so that's encouraging that at least maybe there's some money coming back into the mining and energy sector in the junior department after being heavily oversold. I'd like to see a break up from this rising bottom now. We could get a little mini rally in the TSX Venture. So a market that I've been real negative on for a long time is showing the first little glimmer of hope. I don't want to give anyone the impression that this is a solid looking chart. It's far from that. But it is the first little glimmer of hope. And if you like to trade those TSX Venture commodity stocks, there are some signs here, likely because oil bounced back a little bit last week, and gold has been doing a little bit better, at least been stable, although hardly good. You'll see in a moment why. But yeah, it's a little bit of a hope there for those invested in the TSX Venture. Treasuries, which is the 20-year U.S. Treasury bond fund, broke the downward trend and started to go up here. That was a bit of a surprise because, when you listen to the media, everybody says interest rates are going higher, and yet the chart on the bonds broke the downward trend, which means bond prices are going higher. That means yields are going lower. But a real big downward bearish candle, this is called a bearish engulfing candle, 2 weeks ago. And that is a sign that the sellers are back in play on treasuries. I'd like to see it break down back below this red line, and that would be a cue that bond prices are going down and interest rates are going higher. And if you want to profit from interest rates going higher, you buy the inverse of this ETF, which is something with the symbol TBT. This one is TLT. TBT is the inverse Treasury bond ETF. It will go up when the bond market goes down and basically goes up with interest rates. So something to keep an eye on there, but it's really not a strong chart for either direction yet. I think that you still have to be pretty cautious. I don't consider it a strong trade just yet. US dollar stuck in that bull flag. I call it a bull flag because the trend into the flag pattern is bullish, upward, and we're now just trending sideways in this little flag pattern. You can see it looks like a flag flapping in the wind there. For this to be a continuation pattern, in other words, continue the long-term upward trend in the US dollar, you have to break up through the red line. So we had a pretty good move in the last couple of weeks off of some lows, and we could see it break that upper boundary of that flag pattern, but until it does, I would say it's kind of a neutral looking chart with a slight optimistic bent because the trend into the flag is up. If we can break up through that red line, then that would be a continuation of the US dollar strength, and any sector that benefits from the US dollar strength is going to do well, and those that are hurt by it will do poorly. And of course, oil being one where it tends to do poorly when the US dollar is strong. Gold, we had again a little mini rally in gold a few weeks ago, and it kind of rolled over again last week. Big picture, still a very negative chart. The tops are falling consistently over time. You do get periods where you get 2 or 3 weeks in a row where gold rallies, and if you're a savvy swing trader or day trader, you can profit from that because a lot of these gold stocks will move up 20% in those little 2-3 week rallies in gold. So if you're a short-term trader, take advantage of that. But if you're a longer-term trader, stay away from this thing. It's ugly, and it hasn't been good in many years. So if you're not watching the market and trading it off of a 30-minute chart or less, then I would avoid gold. Now, oil has given a pretty good sign that it's trying to bottom. It rallied back with very strong volume from hitting a new low in sort of a capitulation sell-off mode where everyone was running for the door on oil, and then it managed to rally back. This was 2 weeks ago, rally back to close well above its open and up for the week. And so it's made a pretty good move off of the lows. Still has lots of work to do to reverse that long-term downward trend. So again, if you're a day swing trader, you can move in and out of these things within a couple of days. There's great opportunity in those stocks where you can make 20% in a week because these things get so oversold. However, big picture, still a negative chart, still below the downward trend line, still hasn't built a rising bottom. There's a lot of work that needs to be done. So unless you're a short-term trader, stay away from oil. Fear, pretty high again. It ramped up this week with some more volatility to the downside in the U.S. markets and the Canadian markets. And, that's not a negative thing. It just means you have to trade appropriately. And trying to, buy stocks for the long term is still, I would say, something I'd caution you against. But if you're a trader, then trade things like the VIX, the XIV, day and swing trade, some of these swings in these big name stocks that are moving up and down dramatically because of the volatility in the market. If you're looking to get into the market to buy stocks for the long term, I think you still be cautious because there is some chance that we will see lower prices on stocks still. And I'd rather see you come into the market slowly and without taking on too much risk. All right, so my ratings then. Bearish long term on U.S. stocks, neutral short term. Canadian bearish in both time frames. Gold bearish short term. I put a neutral rating long term. That could easily be bearish. We've kind of been going sideways for a little while, so I was a bit torn with that one. Sorry, that's bearish long term on gold, short term neutral. And oil bearish long term, neutral short term. Again, these things are trying to bottom, but they have a lot of work to do. Volatility continues. Investor psychology is fragile. Investors want to buy the dip, but they're quick to jump out of the market on any bit of bad news. So there's not a lot of confidence among investors right now. Be short-term oriented and take advantage of the emotion that exists in the market. Oil is trying to bottom. Gold, best avoided unless very short-term. And fear remains high. Well, that has been the Stockscores Market Minutes for September 7th. Have a great week in the market and trade well.